Hey everyone, welcome back to Corporate Decoder. Today, the Children's Place Incorporated ticker PLCE just filed its Q1 2026 report, and I am seeing a company deep in transformation, but facing some serious headwinds. Quick note, this is not financial advice, just my take on public filings for educational purposes. Sales are down significantly. And the company is burning through cash, but they are making some bold moves to try and turn things around. Let us dive right into the numbers for the first quarter of 2026, which ended on May 2nd. The company brought in $215.2 million in net sales. Now compare that to the same period last year, May 3rd, 2025, when they had $242.1 million in sales. That is a drop of over 11%, or about $26.9 million less in sales. This is a pretty big hit to their top line. The company blames this on lower customer traffic and a planned reduction in shipments to their wholesale partners. When we look at the cost of making and selling their products, it was $161.8 million in this quarter. Last year, it was $171.3 million, so they did spend less on costs, but their sales dropped much faster. This led to a gross profit of $53.3 million for the first quarter of 2026. Last year, it was much higher at $70.7 million. And this is where it gets tough. Their gross margin, which is how much profit they make before other expenses, dropped significantly. It went from 29.2% last year down to 24.8% this year. That is a 4.4 percentage point drop, and they are pointing to higher tariff costs, increased distribution expenses from exiting a facility, and more markdowns as the main reasons. Losing nearly 4.5 percentage points in gross margin is a serious blow. Then you have the selling, general, and administrative expenses, which are basically day-to-day operating costs like salaries and marketing. These went up slightly from $86.6 million last year to $88.8 million this year. What this means is that these costs are taking up a bigger piece of their shrinking sales pie. They are now 41.3% of net sales compared to 35.8% last year. So, not only are they making less on each sale, but these daily costs are also costing them more relative to their revenue. Putting it all together, they ended up with an operating loss of $42.1 million. Last year, the operating loss was $24.1 million. So, they lost much more money running the business this quarter compared to last year. And when you factor in everything else, their net loss for the quarter was a hefty $53.1 million. That is a big jump from the $34 million net loss they had last year. This translates to a loss of $2.40 per S-hair this quarter, compared to a loss of $1.57 per S-hair last year. That is a substantial increase in their loss per S-hair. Let's look at their segments. The Children's Place did not fare well. Sales dropped by nearly 12% and their operating loss widened quite a bit. The international segment also saw a slight dip in sales and a much larger operating loss percentage compared to last year. It seems the struggles are across the board. Now, what is the company doing about this? They have a multi-part strategy. One of their big priorities is to improve the customer experience across all their channels. They want to focus on their target consumer, offer good value, and make shopping easy whether online or in stores. Another big push is to strengthen and elevate their brands, The Children's Place and Gymboree. This means delivering appealing products and building a strong brand story. And of course, they need to deliver on financial targets. This involves growing sales, improving profitability, and managing their money wisely. They are also working on organizational leadership to drive better decision making and execution. They have been focusing on cost reductions, and a big move this quarter was exiting their third-party distribution facility. They expect this to save them about $10 million annually. This is a concrete step to simplify their operations and cut costs. A really interesting development is that the US Supreme Court ruled that certain tariffs imposed under the International Emergency Economic Powers Act, or IEPA, were unlawful. The company paid about $40 million in these tariffs and is seeking to get that money back. They have already received $5.5 million of it. To get some of this cash sooner, they've monetized some of these claims, meaning they sold the right to receive future refunds at a discount. This shows they are trying to improve their cash situation quickly. Let's talk about their debt. They have an asset-based revolving credit facility, or ABL credit facility, with Wells Fargo. As of the end of the quarter, they had $150 million borrowed under this facility. This is still a significant amount, and while availability under the facility is there, the company needs to carefully manage its borrowings. The interest rates are tied to SOFR or the prime rate, and these can change, impacting their interest expenses. They also have a $100 million term loan from SLR Credit Solutions. This loan is secured by intellectual property, real estate, and other assets. Then there are the Mythac term loans. Mythac Capital is actually a major shareholder, holding over 61% of the company's stock. They have 2 loans from Mythac, totaling over $111 million. It is important to note these loans are subordinate, meaning other lenders get paid back first if something goes wrong. Another significant financial move was monetizing a CARES Act income tax receivable claim. They sold this claim for about $20.1 million, receiving most of it upfront to improve their cash flow. This was accounted for as short-term debt, reflecting the financing nature of the transaction. Looking at the balance sheet, cash and cash equivalents were $4.7 million. That is down from $5.4 million at the start of the year and $5.6 million a year ago. Inventories were $326.3 million. This is actually down from $422.2 million last year, which suggests better inventory management. However, the company has a significant accumulated deficit of $334.1 million. This is a running total of all their past losses. In terms of legal matters, they are involved in a class action lawsuit regarding advertising practices. While they have had some legal wins, like a motion to compel arbitration, the case is ongoing, and a mass arbitration is also in play. Importantly, the company does not expect any material adverse effect from this. Regarding share repurchases, they have a program authorized, but current debt agreements and insider trading policies limit when and how they can buy back their own stock. Most repurchases are actually tied to withholding shares for taxes on employee stock awards. In fact, in the first quarter of 2026, they repurchased just over 8,800 shares, mostly to cover tax withholding. This is a very small amount compared to their overall share count. Interestingly, they reported a benefit from stock-based compensation of $425,000 this quarter. Last year, it was an expense of $1.7 million. This is largely due to how performance awards are being accounted for. Sales are declining and they are losing more money than before. The massive accumulated deficit tells a story of long-term struggles. However, they are taking steps to cut costs, improve their brand, and manage their finances more aggressively, like monetizing their tax and tariff claims. The significant ownership by Mythac Capital, a related party, is also a key factor to watch, as their interests are intertwined. The company's future really hinges on their ability to execute their turnaround strategy and navigate the challenging retail environment. The risk I am watching closely is if these cost-cutting measures and strategic shifts can actually drive sustained sales growth and profitability before their cash situation becomes more precarious. One concrete number that shows this pressure is the 24.8% gross margin, a sharp decline from last year's 29.2%, indicating a real challenge in making money on their products. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord community for more deep market insights.